Greetings, everyone. My name is Joe Scott. I am the senior financial professional of the Rise Up Financial Agency. And today we're going to talk to you about how you decide on how much insurance you may actually need. Okay. As a financial professional, one of the things that we do is we have a formula which we call the D.I.M.E analysis, right? And the D.I.M.E analysis is simply taking a look at your debt, your income, your mortgage, and your education needs for your children. All right. So what I'm going to do is I'm going to share my screen and we're going to take a look at a real life example of what we would do in order to help you discover how much insurance you may actually need. All right. As you can see my screen here, this is for my D.I.M.E analysis. And we're going to look up for our client, John Doe. Obviously, we're not going to use anyone's real information, but we're going to go through the scenario. Okay. So John Doe is looking to buy life insurance, but doesn't know how much he actually needs, right? So let's go through the process together so you can understand how this works. Okay. So John Doe, um, looking to cover his debts. He doesn't want to leave his family with any debts. He wants to make sure they can maintain their lifestyle. So here's the process. In the D.I.M.E analysis, first letter is D for debt, right? Does John have student loans? Well, yes, he does. The average American has about 40,000 in student loans, right? Let's take a look at that. Let's look at credit card debts, right? Remember, we want to leave his family with a clean slate. John has about 10,000 in student loans. Okay. Does he have a car loan? Yes. John recently took out a car loan. He put a down payment, so he owes 20,000 on his new car, right? That gives us a total analysis of about 70,000. Great. Now, John works in IT and John is very successful in his business. So John makes about 100,000 a year. Okay. That's his income, right? And we want to take a look at his income to do an income replacement, right? What do I mean when I say replacement? Well, your family and your loved ones depend on your income to get by, regardless if you're married, have children, or whatever your situation is, right? There's someone that depends on you. With that said, you want to think about if you were to pass away yesterday, right? How much, how many years would you want to leave your family protected for? Meaning, how many years of your income would you want them to have in your absence, right? Generally, if you don't have a specific number in mind, we usually try to go anywhere from 3 years on up to 10 years, right? So let's take a look at this. So John wants to give an average amount. So John says, I want to protect my family for the next 5 years, specifically in income, plus erase my debts, right? So we'll look at 5 years of income at 100,000. That gives us 500,000. Okay. John also has a mortgage, and let's say he lives here in Long Island, New York, and he has a mortgage of about 300,000, right? So we're covering the mortgage, we're replacing his income and covering his debts. And now we're going to take a look at the education costs for his children. So John has two kids in school still, and he wants to make sure that when they go to college, there's enough funds for them to make it, right? This is where you decide on what you want to do. The average cost for a state school over a 4 year period, you're looking at about 100,000. And the average cost for a private school over a 4 year period is about 200,000. That can go up or down depending on where you go to school and depending on when you go to school because prices can go up. So let's take a look. So John has two kids he wants to cover, right? And since he has two kids, John decides that he's going to send them to a state school, right? This may change at a later point, but for the sake of argument, we're going to assume that he's going to send them to state school, right? So that's going to be 200,000. Okay. So based on the full analysis here, as we want to cover 70,000 in debt, 500,000 in replacement income, 300,000 for the mortgage, and 200,000 for his children's school education, right? That gives us a potential insurance need of 1,070,000, right? That is where we're going to start looking at as far as how much insurance John may need. All right. Now you can go up, you can go down. Again, it's totally up to you, but this gives us a baseline of what we can look to possibly cover to make sure that your family will be left in a great position if you are not here to provide for them. All right. I hope this was valuable to you. And if you have questions, please contact me at Rise Up Financial Agency on all social media, or you can go right on the website and book an appointment at www.riseupfinancialagency.com. I hope this was valuable to you, and I hope you guys have a great day.